Well, earlier this week, Donald Trump's one big, beautiful bill aimed at cutting US taxes passed the US House of Representatives. Though largely a domestic bill, it does have a big sting in its tail for overseas investors in America, especially from Australia, and that's called Section 899. Now, this section could see an increase in taxes on dividends or interest earned in America on profits repatriated to overseas countries, including Australia, and withholding tax on passive investment income. And all this comes at a time when there's record Australian investment into America, not just from our companies, but also from superannuation fund and other investors as well. Now, one of those investors perhaps affected is Catriona who is the lead portfolio manager at WAM Global, who joins me now. Thank you so much for your time, as always, Catriona. Your own sense on this. You'd have read it, you'd have looked at this. Is it going to have an impact or not?
Look, let's see. We're early days. Obviously, it's gone through the House, still needs to go through the Senate. And even the House and Senate, in terms of what's being proposed, they need to be reconciled. So there's differences there that need to see reconciliation before they can even go to Trump. Importantly, this isn't affecting capital gains, unlike Labor's policies here, which, you know, we're Wilson Asset Management are very much against. So this is not capital gains. It is, as you said, dividends and income. So there's a difference there. But look, let's see. Still early days, but not a positive direction of travel, but much more water under the bridge still to come. OK, so Australian capital going to the United States is taking advantage of higher returns there as compared with in Australia. Now, that is true for super funds who find a lack of opportunities here to invest in. They're simply too big, so they've got to put money overseas. But it also goes to companies. Many of those chief executives we speak with here simply say, look, sorry, we can't make enough money on our capital here in Australia. We have to go to America. So from your point of view as an investor, you're seeking an opportunity. So anything that taxes them more is a disincentive. Yeah, it does disincentivise. If it's to go through both the House and the Senate, it would disincentivise investment in the US. That is right, and it would reduce the gains that can potentially be made from investing in the US.
All right. Then
look, and I guess the other point, the point in terms of what still has to occur, and in terms of the dividend and income component, though, like there is still much more that has to be reconciled. So it absolutely would disincentivise and incentivise actually going to other countries more. So you would be incentivised to invest less in the US and go more towards Europe, Asia, etc. So that is correct.
OK, so then you sit there and go that this is part of something that is much bigger. The one big beautiful bill is designed to bring down US taxes. What I wonder whether it's also a bargaining chip by Donald Trump and his administration to change the disincentives that we put in place in Australia against American companies. I'm thinking of Google taxes. I'm thinking of, say, the PBS system for our drugs. These are all things that Americans in the past have protested against.
Absolutely, and that could be a deal that is done, that we, give up some of the penalties that we're potentially putting on the tech companies, for example, in exchange for walking back the penalties that would be put on Australia. So there's absolutely negotiation that will still likely go on, and we could come to a much more favourable resolution than what is being proposed at this point.
OK, but given even those taxes that may come as a result of this bill, does it still make it more attractive to invest in the United States, especially given future capital gains, as compared with moving your money to Asia or moving it to Europe or leaving it in Australia?
Look, I think it depends ultimately on what the investment opportunities are. Still, the US is an incredible place for innovation, and when you look at the companies, particularly in the tech space, for example, that are in America, there's still some wonderful businesses to invest in. Some of the best businesses in the world are in the US. So even with this potentially capping the returns that you can generate out of investing in the US, it still may well be the best place to invest, even thinking about the extra penalties we're getting here. And importantly, it may incentivise that companies that you invest in the US to actually give more back to investors in the form of buybacks rather than dividends. And in many cases, in terms of tech companies, for example, in the US, they don't really pay much in the way of dividends anyway. So it actually, in that case, if you're investing in a tech company in the US that doesn't really pay out income and either does buybacks or doesn't even pay dividends, which is very often the case, there will be limited impact. So
good
I think
stuff.
it really depends on what type of investments that you are making in the US.
Catriona, I've got to leave it there. Many thanks for your time. Lead Portfolio Manager at WAM Global.